Welcome to Iron Financial. Today, we are putting Chevron's fourth quarter earnings report on the anvil. We're going to hammer it out and see what it's really made of. Now, the headlines are sending some really mixed signals, and it's our job to cut through all that noise and forge a clear, hard verdict for your portfolio. We don't do hype here. We're all about structural integrity. We need to find out if this company is built to last or if it's just a pretty facade that's going to crumble the second it comes under pressure.
That's exactly right. You know, on the surface, the numbers look pretty good, but I'm already seeing some potential stress fractures. Our job today is to really figure out if this is a steel-plated opportunity you can build on, or if it's a structure that's about to crack under the weight of reality.
Okay, let's just dive right in. The central question we're tackling is actually pretty simple. Did Chevron spend 2025 building a stronger foundation, or did they just slap a coat of paint over some serious weaknesses? I mean, let's be real. They're a titan of the industry, a true super major. But you know what? Even the biggest, most impressive structures can have hidden flaws, and our job is to find them.
And we are going to stress test every single part of this report, every claim. This is not about what the press release says, it's about what the numbers prove. So let's lay out the blueprint for how we're going to get to the bottom of this.
So here's our game plan. First, we're going right under the hood to look at the earnings numbers. That's where you see all these conflicting signals. Second, we're going to inspect the growth engine, their production, to see if it's really built to last. Third, we'll get into shareholder value and assess whether this is a genuine fortress for investors or just a facade. And finally, after we've weighed all the evidence, we're going to deliver the Iron Financial verdict. All right, let's get right into the thick of it, the core conflict. This is where all the confusion really starts for most people. On earnings day, the news wires just lit up with two completely different stories about the same company on the same day. One headline is screaming victory, and the other is signaling some real trouble. It's the classic battle between Wall Street's expectations and cold, hard reality.
Exactly. On one hand, you've got this story of incredible operational strength, of beating the analysts' expectations. This is the bull case. It's the narrative of a well-oiled machine that can perform even when things get tough. So let's look at the numbers that are propping that story up.
Okay, so this slide really shows the power of efficiency when you're under pressure. Over on the left, that's the bull case right there. The market, the so-called experts, expected them to earn $1.45 per share on an adjusted basis. Well, they delivered $1.52. Now, in an environment where crude prices are falling, beating the street's estimate is not an easy thing to do. It shows incredible discipline. It tells you they are absolute masters of cost control and operational excellence. They're literally squeezing more profit out of every single dollar that comes in the door.
Discipline? I'm looking at the right side of the screen, and I see a 10% drop in revenue year over year. That's a fall from over $52 billion to under $47 billion. I also see profits falling hard from $3.2 billion down to $2.8 billion. You can't just discipline your way out of less money coming in the front door. That is not a sign of strength. It's a clear sign that the fundamental business environment is getting a lot tougher. You can be the most efficient company on the planet, but if your top line is shrinking, that's a serious headwind. How is that not a giant flashing warning sign?
Well, the crucial point here is understanding the headwinds they were sailing into. This wasn't a failure of execution on their part. The entire industry was facing this storm. You have to consider the macro environment. Brent crude, which is the big international benchmark, it fell from an average of $75 a barrel in the fourth quarter of 2024 to just $64 in Q4 of 2025. That is a massive drop that hits every single oil producer in the world. So this isn't a Chevron problem, it's a market problem. And they mitigated it through that efficiency, which is exactly what a best-in-class operator is supposed to do.
Okay, but it highlights a fundamental vulnerability, doesn't it? A crack in the foundation. Their entire structure is totally exposed to the violent winds of commodity prices. A beat on earnings is a nice little talking point for the quarterly call with analysts, but the fact remains that their profitability is fundamentally tied to a number they have zero control over. When the tide goes out, even the biggest ships can hit the sand, and right now, it looks like the tide is going out on oil prices.
All right, let's move on and see how this all builds. If the revenue you get from the price per barrel is down, you have to look at the other side of that equation, volume. How many barrels are you actually pulling out of the ground? And on this point, Chevron's production machine is just running at full capacity. It's shattering company records. This is where the story of real strength truly takes hold. A machine they bought, you mean. It's pretty easy to get bigger when you go on a massive shopping spree with shareholder money. So let's not get ahead of ourselves. I want to see the numbers and find out where this growth actually came from. The numbers here are just staggering. Look at this, a 20.7% jump in production year over year. That's a huge increase from 3.35 million barrels of oil equivalent per day, we call that MBOED, to over 4 million. They set new annual records for both their U.S. and their worldwide production. This is the heavy lifting that supports the entire enterprise. This isn't some minor uptick, it's a quantum leap in their output. It's undeniable, tangible growth.
Oh, it's completely deniable if that growth came from a shopping spree. They spend billions of dollars buying Hess Corporation. You can't just go out, buy another company's assets, slap them on your balance sheet, and then call it organic growth. So the key question here is how much of that shiny new bar on the right is organic, homegrown Chevron muscle, and how much is just stuff they bolted on from the Hess acquisition? Let's break it down.
And there it is, clear as day. Just look at this donut chart. Of the total production growth for the entire year, more than 2/3 of it, 261,000 barrels per day, came from buying another company. That's not building a stronger foundation. That's like buying the house next door, knocking down a wall, and then claiming your house is bigger. So what about their own projects? The legacy Chevron operations only added 124,000 barrels. To me, that's the real measure of their internal strength. That's a really cynical take, and I think it misses the entire strategic picture. The Hess integration was a masterstroke. It wasn't just about buying production, it was about buying premier, high-quality assets in Guyana, which is one of the most exciting oil discoveries in a generation. And hey, don't just dismiss the organic growth. 124,000 barrels per day is significant. That's being driven by incredible performance in the Permian Basin and the successful startup of key projects in the Gulf of Mexico. This isn't an either-or situation. This is a two-pronged growth strategy, and it's working perfectly. Right. This wasn't luck. It was a clear, four-step execution of a very deliberate strategy. First, they successfully integrated Hess, and they hit their synergy targets. Second, they delivered on their massive Permian Basin production goals. Third, they launched major new projects in the Gulf of Mexico and Kazakhstan. And fourth, looking ahead, they are now forecasting another 7 to 10% production growth for 2026. This is the blueprint for a modern energy supermajor. It's about combining smart acquisitions with relentless operational excellence.
A blueprint that's getting more and more dependent on these massive multi-billion-dollar acquisitions or really complex international projects in places like Kazakhstan and Guyana. You know what that does? It adds geopolitical risk. It adds integration risk. It adds a ton of complexity. That adds risk to the structure. It doesn't remove it. The bigger they build, the more points of failure they create.
Okay, let's talk about the payoff. The payoff for the owners of the company. If the company is performing so well, if this whole structure is as sound as you say it is, then the shareholders should be reaping the rewards. So the question is this a fortress of returns, a safe haven for investor capital? Or is it just a pretty facade that's designed to look good from the outside, while the inside is actually pretty questionable?
It's a fortress, an absolute fortress. And it has been one for decades. This isn't a new story. It's a continuation of a long-term, ironclad commitment to shareholder returns. Forget the rhetoric for a second and just look at the raw numbers.
In 2025 alone, Chevron returned a staggering $27.1 billion to shareholders. That is a direct transfer of value. It's a combination of paying out dividends and aggressively buying back their own shares. This is not a company that's hoarding cash. Its primary job is rewarding its owners, and they are doing it in a massive way. And this number is the bedrock of the entire fortress. They just announced their 39th consecutive year of dividend growth. Think about that. Through oil booms, through busts, through global crises. For nearly 4 decades, they have consistently raised that dividend. That is the very definition of a reliable, solid financial structure. Look, the CEO himself underscored this exact point. He said they delivered superior returns even with the significant headwind of lower prices. Now, that doesn't happen by accident. That comes from a position of immense financial strength, specifically a record $10.8 billion in cash flow from operations just this quarter. That cash is the lifeblood of the company, and right now it is gushing.
The rhetoric is strong, I'll give you that. Industry-leading, superior returns. It all sounds fantastic. But you know what? Actions speak louder than words. If the outlook is so solid and the returns are a fortress, then why is management, the very people running the company, the ones who have the most information, why are they selling off their own stock?
Let's look at what the insiders, the C-suite executives, the people in the boardroom are doing with their own money. In the last 6 months, there have been 0 open market purchases. Not a single insider looked at the stock price and thought, you know what, this is a great deal, I'm buying more. But there were 9 sales, 0 confidence to buy, but plenty of motivation to sell. To me, that is a loud and clear signal from the people who know the most about this company. And we're not just talking about minor sales for tax purposes here. John Hess, the man whose family company Chevron just spent billions of dollars to buy, cashed out over $142 million worth of stock. The company's own controller, a woman named Alana Knowles, and another vice president also sold shares. You don't get rid of the bricks to your own fortress if you think it's going to stand strong for years to come. When the ink is barely dry on the biggest deal in years and the primary seller is dumping stock, you have to ask yourself, is this a lack of faith in the very synergy and growth story they just sold to the market? This is a massive, massive red flag.
That is a tough data point to ignore, I'll admit it, especially the size of that Hess sale. But context here is crucial. Insiders sell for a lot of reasons that have nothing to do with a lack of confidence in the company. Things like diversification, estate planning, major personal purchases. A sale is not automatically a bearish signal. You have to weigh that piece of information against the hard facts. The core financials, the record cash flow, the surging production. Those are the structural pillars of the company.
Okay, we've stress-tested the components, we have examined the earnings, we've drilled down into production, and we've analyzed the shareholder returns. We've looked at the strengths, and we've put a bright spotlight on the cracks. It is time to bring it all together and deliver the final verdict from Iron Financial.
Market skeptic, let's lay out all the evidence one last time. This is the final weigh-in. What are the solid pillars that are holding this company up? And what are the clear cracks in the armor that could potentially bring it all down?
The pillars supporting this company are undeniable, and they are made of solid steel. It is a cash flow machine, generating billions and billions of dollars, even in a tough market. Its production volumes are at record highs and are set to grow even more. And it has a nearly 4-decade history of raising its dividend, making it a true fortress for income investors. These are the steel beams of the operation.
But the cracks are just as real, and you ignore them at your own peril. Revenue and profits are down year over year, period. That powerful production growth is heavily reliant on a massive acquisition, not just organic strength, and that introduces a whole host of new risks. And the insiders, the people with the actual blueprints to the building, are selling, not buying. You can't just plaster over these stress fractures and pretend they don't exist.
So my verdict is this. The structure is sound. Chevron has proven its ability to generate massive cash flow and manage its costs effectively in a really tough price environment. They are executing a clear, long-term strategy. The acquisition of Hess was a necessary strategic move to secure premier, low-cost assets for future growth. This is an all-weather operator that's built to last, a true blue-chip cornerstone for a portfolio.
Well, my verdict is a lot more cautious. I believe this is a potential trap for investors who are just focused on the rearview mirror of dividend history. The declining revenue and that alarming insider selling are clear warning signs about the road ahead. The foundation feels solid for now, but the ground underneath it is shifting. Relying on massive acquisitions for your growth is a risky and incredibly expensive game to play. There are just too many cracks here for me to call this structure perfectly sound.
And ultimately, that's the question every single investor has to answer for themselves. Do you bet on the proven track record, the incredible cash flow, and the rock-solid dividends? Or do you hedge against the declining revenue and the serious warning signs from the insiders? Here at Iron Financial, our job is to give you the tools to make that assessment.
We've shown you the blueprint, and we've pointed out all the potential flaws. We've given you the bull case, and we've given you the bear case. The final decision on whether to build this stock into your portfolio, well, that's yours.